Yeah, so I can start us off just kind of walking through some of the charts that I put in for this week. So to start off, obviously the big news this morning is the new CPI data value. And in case you missed it, May CPI came in at 8.6%, which was 30 basis points higher than the average consensus estimate, which was 8.3%. So the deal there is that the market, at least in the short term, operates on these estimates. So you have analysts at all these big funds that are estimating what they think CPI is going to be, and then those funds operate on that assumption. So if they're guessing that CPI will be around 8.3%, and then it comes in hotter than expected, obviously you run into some selling. So that's kind of what we're seeing today. So if any number had come in less than 8.3%, we probably would have seen a bounce today. But because we saw 8.6%, we're seeing some selling. So that's headline CPI. And then there's also core CPI, which measures CPI excluding food and energy costs. That was actually down for the month of May. It was down to 6%. And that honestly isn't too surprising to me, because a lot of what's driving this current inflation, now in the middle of 2022, is this oil appreciating, and all these energy costs that are rising. So seeing core CPI down while headline CPI is up isn't too big of a surprise to me. So I put in the at the top there's those charts. To me, it's on the far right. I'm not sure where it is for you guys, but you can just see a chart of headline CPI. It shows 1915 to today. And basically what you can just see is that inflation's at a 40-year high, right? We haven't seen CPI above 8% since the early 80s. And I also like to talk about and just mention that I think it's important for people to understand is that CPI is a kind of a flawed metric, and it's arguably not a great indication of actual inflation levels. So maybe if you don't understand exactly how CPI works, they're taking a basket of goods. So things that they think an average consumer consumes. So whatever, a gallon of gas, carton of eggs, a loaf of bread, whatever, and they're comparing how much that basket of goods cost in May 2021, and then how much it costs in May 2022, and then the difference in prices is your CPI. But the issue is a lot of that basket of goods gets adjusted pretty often. They change what's in the basket. They do that generally to keep the number lower. And a lot of that comes from political pressures. So people in office, a lot of their voting rides on people's perception of economic health. So if they think the economy is going bad, then they might not vote the same way for the next voting cycle. So a lot of times you see this pressure to keep CPI down. And furthermore, it's this idea that inflation, isn't a flat, data value. It's a vector. So what that means is that the inflation rate is different for different types of goods. So, like, for example, the price of a Big Mac doesn't really increase year over year that much, right? So the inflation rate for a Big Mac is really low, but the inflation rate on a gallon of gas, for example, is a lot higher. So inflation is a vector. It's not a one size fits all kind of value. But CPI is obviously the most widely used and accepted measure of inflation, so it obviously has this big impact on the markets. So with higher CPI values, there's all this pressure on Powell to raise the Fed funds rate, at an even greater rate to try to slow down these price increases, to slow down spending and bring prices down. But the Fed has lost so much credibility recently, pretty much from the fact that they kind of overshot their expansionary monetary policy, right? They way overdid it, the course of 2020 to 2021, and that's why we're seeing all this inflation now. So I don't think it's crazy to think that the Fed will abandon their plan. They've been saying we're just going to continue to do these 50 basis point rate hikes. I don't think it's crazy to say that they'll abandon that and go for a 75 basis point rate hike in the future or something like that. I mean, obviously, I have no idea what they're going to do, but that's just kind of what I'm thinking. And if they start to do that, I mean, it'll probably bring CPI down, right? Because people have to have larger interest payments, and they'll spend less money on other things. But I think that would create a lot of problems, a lot more dangerous problems. If you read last week's newsletter, I talked a lot about that. I won't, harp about that right now. But other than CPI, I think the other big headline this week is crude oil prices. So they've been climbing this week. They're at 14-year highs. Right now, it's sitting at about 120 a barrel. And the Biden administration is actively trying to get these prices down, right? So one way they're doing this is they're depleting and selling oil from the U.S.'s strategic oil reserves. So this is kind of oil that we've set inside in case of doomsday, in case of disaster, in case we ever need to have oil on hand. That's what we hold on to the oil reserves for, and now we're selling them in order to get more supply out there in the market and hopefully bring prices down. But that's obviously not working. And then alongside rising oil prices obviously comes higher gas prices, which are at the highest they've been in history. So, this morning, last time I checked, the average U.S. national gas price was $4.99, and it's never reached $5 before. And the last peak that we saw for gas prices was in 2008, and now we're over 20% more than what we saw in 2008. So higher crude prices obviously brings higher gas prices, but it also feeds this inflation as well, because gas isn't the only thing that we need oil for. Most goods require oil and petroleum in some way to produce them. So it's like think about pretty much any good out there. You probably need oil in one way or another to produce it, whether that's in the supply chain or in their actual production. So we see that oil prices and CPI are extremely correlated. So I think that chart should be up top somewhere, comparing oil prices and CPI, and that's kind of the reason. It's just that oil is an input for most products out there. So we're in this commodity bull market, and that's not a good thing for consumers for the most part, because the prices of capital goods, of inputs, rises. And then that increases the prices of energy and for food, because petroleum and oil is a big input for fertilizer, which makes producing good food more expensive, and increases prices on the shelves. So this creates this drop in discretionary spending, right? So if you have to spend more money at the gas pump and more money at the grocery store, you're probably not going to spend money on things like taking a vacation or going out to eat at a restaurant, or things like that, discretionary spending. So what happens is that hurts bottom lines of companies, right? It decreases earnings, and if that decrease in spending is deep enough, these companies will start to lay off their employees because they can't afford to keep them on board. So that combination of decreased spending and layoffs usually results in a recession. Another thing I wanted to mention, on Wednesday there was some data released about consumer revolving debt levels. So if you don't know what revolving debt or revolving credit is, it's basically the way to allow someone to spend credit while they repay portions of their debt while simultaneously taking on more debt. So that's how your credit card works, basically. So revolving credit is the most commonly held debt in the U.S., and credit card debt is the most common form of revolving debt. So basically, this data value that came out this week is essentially just showing us how much credit card debt there is out in the United States. So what we see is, under these extreme circumstances, you have low interest rates for a prolonged period of time, which fosters a ton of spending and credit creation. And then you have the expansion of the monetary base through government spending packages, increasing the supply of dollars out there. And all this does is it just makes the prices of goods rise. And the issue is, at this point, if we look at this revolving debt level, and the chart should be in there somewhere at the top, but basically we're just looking at, the amount of revolving debt, how much credit card debt there is out there compared to the Fed funds rate. And then I also overlaid recessionary months on there. So those are the vertical gray lines you see. So this issue is, Americans have built up so much debt, but the Fed needs to increase interest rates in order to bring down prices of goods. And there's so much debt out there that people are like, well, we can't afford our interest payments anymore. That obviously causes a bunch of issues. and I talked about this, a lot of it last week. So it's kind of this massive issue, right? Over rising interest rates, tons of debt in the system. We have more debt in our system than we've ever had before, and it has the potential to create a lot of issues. Some other news this week: we saw the ECB, the European Central Bank, who are becoming increasingly hawkish, and they're now raising their interest rates, only 25 basis points, but they're also starting to see CPI numbers above 8%. I also included a chart of, I'm not sure what it is up at the top, U.S. initial jobless claims. So we're starting to see an uptick in, initial jobless claims, which is basically measuring the amount of claims there are for unemployment benefits for the first time following losing your job. So right now they're not terribly high, so it's not, a huge concern at the moment. But they are increasing. So if we start to see this continue to increase, it could be super dangerous, right? And only once before, so this would potentially signal stagflation, which we've only seen once before in the 70s. But essentially, what you saw is you have economic output receding, right? So you have a recession, but Americans are losing their jobs, but you are also having inflation, right? The prices of goods are going up while the economy is receding. So this is kind of the period where Paul Volcker stepped in, who was the chairman of the Fed at the time, and he buried inflation, right? He cranked the Fed funds rate up. It was up to 20% at one point. But the issue with that is, we can't really do that now because of how much debt there is in the system, right? If they crank interest rates up, to the moon, nobody can afford their interest payments anymore. Then people are just going to default in their debt. Powell has even compared himself to Volcker a couple times. But like I said, he's not really in that kind of position that Volcker was in, just because of how much debt there is in the system. We're way more indebted today than we were in the 70s. And also on Tuesday is PPI announcement. So that's Producer Price Index, which is a leading indicator of CPI. So generally, input prices will increase, which causes producers to feel the inflation. And then over time, that spills over to the consumer because the producer has to raise the prices of their goods. So headline PPI in April was 15.7%. I'm not totally sure what the consensus estimate is there, but be on the lookout for some higher values. And then that's pretty much all I had on the macro front. I talked a little bit about the stock market as well. Obviously, yesterday it kind of tanked into the close. S&P and the NASDAQ broke some key support levels, and that was mostly in preparation for today's CPI announcement, right? So a lot of investors don't want to be long stocks before an announcement when you don't know what's going to happen. And you also probably had a lot of shorts entering as well, expecting hotter than expected inflation levels. But I think, other than that, there's a little bit of a breadth breakdown in the market. So we're looking at, how many stocks are participating to the upside or the downside. In the newsletter, I included a chart of the advanced decline line for the NASDAQ, which is a breadth indicator. It basically just tells us how many stocks are participating up or down. And it kind of tanked yesterday, just showing us that, a lot of stocks were declining, which is, obviously a cause for concern. And I won't get in too much into the crypto exposed equities part of it. Not a whole lot has changed here for the last several months, right? But they've had a week, right? There's a few names that are holding up pretty well. I personally think that MicroStrategy, CAN, BTCM, and Coin are some of the best looking of those stocks, but I'm not personally interested in being long any of those equities.
Blake, I got a question for you about stagflation, right? Obviously this is really bad. Inflation's bad, recession's bad. But for the Fed and the political incumbents, which would you think is worse? And which do you think they would be more likely to try and tackle and let the other one get out of hand?
What do you mean between inflation and
if they had to choose between, letting unemployment get bad and handling inflation, or letting inflation get bad and handling unemployment, what do you think the Fed would be more likely to do?
I think it's hard to say. I mean, the Fed has said a lot that they're hyper focused on inflation, and that's kind of their goal by raising interest rates. But on the flip side, obviously the unemployment's a big issue, right? Especially if you're a politician, because that's a huge driver of voting, right? If there's high unemployment, right, who's going to want to vote the same way? So I think it's kind of hard to say, but at this point, it doesn't really feel like they have a choice for either, right? If they raise interest rates, that brings in a recession. I'm not 100%, but chances are you're going to start some sort of recession, right? Because people have to spend less on other goods because they have higher interest payments. So that like I said, that squashes earnings a little bit for these companies, and that causes unemployment. So I'm not totally sure. I think it's a tough question, and I definitely would not want to be the chairman of the Fed right now.
You and me both, bro. So, Joe, what's new on the mining front?
Yeah, I can tackle some mining. So, two things that I covered in the newsletter this week. The first one was related to New York's mining ban bill that the legislature passed last week. The update is that it doesn't look like that bill is going to be signed or vetoed by the governor anytime soon. The governor and her team basically are going to be looking very closely at the bill over the next 6 months, is what she said. Second topic that I'm going to talk about is hash ribbons. For those that don't know, hash ribbons is basically a metric that allows you to basically determine, hey, is hash rate growing, or are our miners capitulating off the network? And so we actually kind of saw a mild cross on hash ribbons, basically just indicating that these old gen machines turned off. But in the newsletter, I also show a table or just a graphic that kind of shows some key mining metrics. One is hash rate. So the 14-day moving average of Bitcoin's network hash rate hit 219.2 exahash per second. And just to get an idea of like what that actually means, that would actually be 2.3 million S19s all running. Obviously, the network is made up of a bunch of different machines from Bitmain, MicroBT, Avalon, and others. But of those new gen machines, that would be over 2.3 million. In reality, when you account for all the old gen machines that we still have out there, like many S9s, there's probably many, many more millions. But just going in a little bit deeper on the two topics, I'll keep it relatively short. But the New York mining ban is very interesting. New York right now is the fourth largest state in the U.S. for Bitcoin hash rate. 9.8% of the entire network hash rate is in the U.S. But I think this mining ban bill, even if it doesn't get passed, if the governor vetoes it, it's really kind of a bad look for the state of New York. And when you are, a mining company, you're going to be very cautious about where you set up your facilities. Like we've learned from China, we've learned from Russia, we've learned from Kazakhstan, and now we're learning from New York that you can't build these massive facilities that can't be moved very easily. You can't move your energy contracts with your local utility, your local grid. None of this can be moved there easily. So finding a stable political jurisdiction where you build these facilities is highly important. And just the fact that New York is potentially going to ban future Bitcoin mining facilities, it's just enough to where if you're looking to set up a facility, New York's just not even going to be remotely near the top of the list.
Hey, Joe, I have a question for you. So one thing that we had put in the newsletter this week was this metric called hash price, right? And I think it's very important for people to understand how miner margins in aggregate are getting compressed right now. And with that, we've started to see some inventory being sold off from miners. So could you talk a little bit about the significance of that hash price, what's going on with miner margins, and how we've kind of seen some selling of Bitcoin inventory as a kind of result of that?
Yeah, so over the last couple of years, hash price has been trending down. And hash price, for those that don't know, it's basically the dollar per terahash that you get per day from your machines. And basically, miners are kind of long Bitcoin and they're short difficulty. So when difficulty starts going up and the price of Bitcoin is going down, miners' margins are getting crunched. And we've seen that, like Will was mentioning, Riot has been selling some Bitcoin that they've been mining. Cathedra is another smaller Bitcoin mining company that basically capitulated their treasury of Bitcoin. So miners are definitely feeling the pressure, and a lot of them, even if they are still operating with profitable margins, some of these larger companies are just trying to take a more conservative approach going forward. But yeah, no, I mean, just wrapping it up real quick, the hash driven metric is a good metric. It kind of showed that, like I mentioned earlier, that some of these old generation machines like Bitmain's S9, which as of a month or two ago accounted for maybe 18% of the network according to CoinShares research, some of those are very likely turning off as they're now unprofitable. And I do have a table in the chart, but I'll wrap up mining with that. Yeah, I guess, Will, you can take it for however long you still have.
Sure. Yeah, I do have like one final question for you, Joe. Sorry to keep you on the hot seat, but like, what do you think the probability would be of some type of final miner-led capitulation move similar to 2018? Do you think their impact on the market is not as significant? I guess just how do you think through the likelihood of that event? Like, what would be the magnitude of the effect on the market, similar to using 2018 as kind of the main comparison?
Yeah, I mean, I think because we kind of just had a very minor capitulation. I think it's a good point. I mean, it wouldn't surprise me too much. I think if like we dropped down to 20,000 or so, that would turn off pretty much a good bit of pretty much all of the S9s probably, and maybe start to get into some of the S17s, which are more mid-gen equipment. But I think like the China mining ban kind of like knocked out a lot of miners, so difficulty is still relatively low to what it would have been if like we never experienced the China mining ban. So like if you're running new gen machines, S19, and we're about to get the S19 XP, like your margins are still very solid. So it's like the only machines that are going to be turning off are these old gen machines, and I don't think I think the price would have to fall like very significantly further, maybe like 15,000, which just seems highly unlikely for there to be any like sort of really serious minor capitulation. But I could be wrong. But I do think that like the minor one that we just saw, and then if we maybe go down a little bit further and more machines happen to turn off, I think that's a fantastic sign that like, hey, like we're likely bottoming. Cost of production is going down. Just historically, minor capitulations have been marking Bitcoin bottoms pretty accurately.
That's awesome. Yeah, thanks for that, Joe. I do have to jet in 3 minutes for a call, but I guess from a high level, I'll run over a few different data points. I guess the few that I kind of found most important, just to keep it brief. I think we've, at least in my section, have had kind of this similar trend of everything that I've been saying, because quite honestly, just not a whole lot has changed from a price action standpoint, and therefore some of the other derivative metrics that are based off of price action in that regard. I think what we've been saying, and still holds true. We're in the lower 10 to 25th percentile of all historical valuation metrics for people averaging in. I still think this is a great time to do so. With that being said, for some of the kind of historical pico bottom signals that have formed from a lot of these valuation models, we still haven't reached quite those levels yet. One of the things that I talked about in the newsletter this week was the state of short-term holder profit and loss. The total percent of profit held by short-term holders reached one of the historical lows. It's only gone lower a few times over the last few weeks, and that's translated into the short-term holder profit-loss ratio created by ARK Invest, reaching the third or fourth lowest rating in Bitcoin's history as well. What this means is that pressure is being put on short-term holders. That's translating to some capitulation, and you're seeing that through the short-term holder cost basis, which is the short-term holder realized price based on the last time coins were moved. And so that's come down now from about 47,000 over the last month down to about 36,000 now. At the same time, you've got the long-term holder cost basis rising now up to 22,300. And so what happens in the bear market is you tend to see this dynamic where the long-term guys are buying the dip, as well as you're seeing the short-term guys age into long-term holders, and that translates to the long-term holder cost basis rising while the short-term holder cost basis declines. And whenever you get a cross of those two, that's marked kind of the generational buy opportunities for BTC. And you could see that chart in the newsletter at the bottom of the 2012 bear market, 2015, as well as the 2018. And again, we're approaching that. We're still, again, $14,000 away from the two crossing. But if the trajectory continues, looks like they'll likely cross kind of in the upper 20Ks. So that's one of the main kind of metrics that I'm looking at to say, okay, with high conviction, we've likely reached the bottom with confidence. The other one is just the MVRV Z score that we've had in the newsletter for the last month or so. This compares the market price to the aggregated realized price. Instead of looking at long-term or short-term holder, this is just the aggregated version of realized price. So essentially the average price that investors have paid for their coins. Whenever market price goes below realized price, that means in aggregate the market is underwater. And right now realized price is at 24,000. So if market price goes below 24,000, then we'd enter that green zone at the bottom of the chart shown in the newsletter, signaling kind of a generational buy opportunity that we've seen only 3 other times in Bitcoin's history. The 2012 bear market, 4 other times, the 2015 bear market, 2018 bear market, and 2020 during the COVID dump. On the derivative side, seeing just a continued spot premium, which is taken place for several months now, and I think is just something to keep in mind as kind of a backdrop for the rest of your market outlook. Just showing derivatives have cooled down. You see that also in like the 3-month basis, and then if we look at the futures perpetual funding rate, this is based on the delta between spot and futures. I should say that the spot index and the perp price. This has been kind of in this muted regime for a while, and what we want to see to feel real strongly bullish about this particular, you want to see a regime of negative funding, which we saw after the COVID lows, October of 2020, and recently the summer of 2021, which was one of the things that we were feeling extremely confident about a short squeeze at the end of July. Looking at funding rates paired with a few other things was one of the main signals that we used to feel that convicted in that happening. So watching for the regime of negative funding right now, we're just flat to slightly neutral, not in a clear regime of negative funding rates yet. The minor stuff Joe talked about, as we mentioned, starting to see some decline in the minor net position change, which is showing that again their margins are getting compressed, having to shave off some of that inventory. And then the last 2 charts, we look at the amount of supply that hasn't moved in at least a year continues to climb up to 65.5%, which is just, in my opinion, to an extent showing just the amount of conviction of Bitcoin natives during this time of just economic and geopolitical uncertainty over the last 3-4 months. So that's a very interesting chart to just see that continue to push up to new highs. And then lastly, when we look at this trading hour premium chart that we've talked about for a while, I think I posted this like several times now in the last 2 months. The Asian trading hours continue to trade at a premium to the United States and Europe, which has been a good signal over the last few years as Asia's really dominated the market, buying the COVID lows, or I should say selling right before the COVID dump, buying the COVID lows, selling into the peak of 2021 into April, buying back at the bottom of summer, right in the middle of that, bottom range over summer from whatever, you want to call it, like 29 to 35K, selling the pump off those lows after summer, buying back in September, and selling down in late November into December of last year. They bought in January earlier this year and then sold back at the top of the range while we ranged and pushed up to 47K, led by Do Kwon buying. And then recently, we've seen the premium get back up to the highest levels it's been at since summer of last year. Has started to decline a bit this week, but I would still say it's very much so in the positive territory. So that's something we continue to monitor and think is a good signal. But hey guys, I apologize for being so brief and like talking a million miles an hour. I just have to jet for a call and I'm running a few minutes late, so I'm gonna pass it off to whoever else wants to take it from there. But we'll be back next week at 1 o'clock for whoever wants to tune in or got some value out of this.
Yeah, thank you everybody for joining. Will, that was a good on-chain speed run. So we'll be back next week.